Welcome back. Today I'm going to go into more depth around mortgages, the intricacies around them and how you actually get them. It's about serviceability and it's about deposit. Understanding what the banks want so you can deliver and get that mortgage that you require. It's not the mortgage you want, it's the property we want, but unfortunately that bank stands between us and our dream property and our dream investment. So when the bank is looking to give you money, logically speaking, the key requirement is this. They want to minimize their risk and increase their expense to you. How do they minimize their risk? They have two factors. One is serviceability, one is deposit, as discussed earlier. When it comes to serviceability, they want to know, based on your income, can you afford to service that extra expense? In other words, month in, month out, based on your current situation today, can you deal with it tomorrow? So the first thing the bank wants to see, a bank account with the money coming in consistently month by month, week by week, fortnight by fortnight. It has to be consistent to the day. If your employer uses a different title every week, every fortnight, every month, then you're going to be in trouble. If they come 2 days late, 2 days early, then you're going to be in trouble. Make sure it is on the spot every single cycle. The next thing they want to see is above and beyond your expenditure, do you have money left over? This is called genuine savings. If my brother put me $1 million into my account tomorrow in order to service or get a loan, will I be approved? No. Unless the money is seen as genuine, shown through genuine savings, showing that you have the discipline to pay this loan, then generally, genuine savings will stop you from getting that loan. In the event that my brother put that $1 million into my account 6 months ago and it's maintained its consistency in that format or gone up, then yes, things are good. When they're also doing the serviceability analysis, it comes down to exactly how much you have left over. The narrative does not play a part. If you say to the bank, yes, I am paying $1,000 a week in rent, if I took that money from the rent and put it on my mortgage, then I can afford it. The bank doesn't care. Very simply put, they want to see genuine savings above and beyond. Based on your situation today, can I afford this tomorrow? The next is about deposit. How much deposit do you actually need? Now, technically speaking, some banks will allow up to 95% LVR, which is loan to value ratio, which means they will lend you 95 cents to every dollar that you need. So if you have $1 million loan, they could technically lend you $950,000. But what does that actually mean? What are the expenses associated with that loan? Firstly, there's something called Lender's Mortgage Insurance, LMI. This is an insurance the bank takes on your behalf that you pay for. And LMI, in full practice, is this. You have a loan for $1 million that you need to take out. So the bank will lend you $950,000, you come up with the next $50,000. Now the bank needs to guarantee 80% lend. So that extra 15% is now being insured. The insurer is telling the bank, if Peter defaults, then we will cover you. We will give this to you, Mr. and Mrs. Bank Executive, to make sure that when you sell the property, you will not fall short in the valuation. This is an exorbitant cost and cannot be factored into the loan if it's a 95% lend. It has to come as part of that 95%. So you may have a $50,000 deposit, but you may also have an $80,000 lender's mortgage insurance premium that you may pay out of pocket. That takes that deposit to $130,000. Is that all? There's still the stamp duty. This is the government tax associated with your purchase. The stamping of your document, the changing of title. A very exorbitant cost, particularly in Sydney, because the system came into force multiple years ago where there was $400,000 properties and it wasn't so expensive. Nowadays, not so much. You can be paying up to $70,000 to $80,000 for stamp duty, up to $300,000 depending on the property you're purchasing. That has to be factored into the deposit context. So initially you had a $50,000 deposit. Again, you have the LMI on top and you have the stamp duty on top. That has to fall within that 95% lend. How do you then actually figure out what the deposit needs to be? How do you avoid LMI, for example? In the context of LMI, you need to have a 20% deposit in order to avoid it. If you have a 20% deposit, you remember you have to factor in on top of that stamp duty. Now, how do you decrease stamp duty? It's actually not really possible. It just comes down to what you're paying stamp duty on. So let's say, for example, you're doing a house and land package. If you purchase the land, then the stamp duty will be applied to the land and not the actual building component. But if you buy a house and land together, then you have to pay stamp duty on the overall value of that premises. That being said, we don't always have that choice. But the important thing to note from all of this, make sure your pay is consistent, make sure you have genuine saving, and make sure you consult an expert about how much deposit you should have. Thank you again so much for visiting us today. There will be more to come on the mortgage topic next week. Please subscribe. Please invite your friends. Our goal is more advice to more Australians. Take care.